Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. I like to have him on every couple months for his input on commodities. He is truly an expert. He's a former vice president at Sprott Inc. He started Rule Investment Media, and for over 3 decades, he has successfully financed mines, successfully financed a lot of junior mining companies, and he's been an investor and speculator in many different types of natural resources and commodity companies over the years. Rick Rule, thank you for joining me again.
Jason, thank you for the opportunity.
So, Rick, we're recording this interview on Tuesday, August 29th, 2023. We've actually had a rally in the gold price, the US dollar spot price for the gold price today. It's up to $1,937. The silver price has rallied substantially. It's up almost to 25 at $24.69. But before we talk about gold and silver and some of the miners, I want to get your thoughts, though, on the Fed's interest rate hikes. And because you're a credit analyst and you've been analyzing credit and looking at companies' credit, balance sheets, consumer credit, the effects of the Fed rate hikes on credit and the real economy.
I'm frankly surprised and delighted with the nominal strength of the U.S. economy, given the fact that the price of credit and, in fact, the price of capital has increased so much. I'm cautious about the fact that the impact of this increased cost of capital may be lagged, which is to say we may not have seen all of the deleterious impact as a consequence of the increased price of capital that we're going to see. But I'm frankly delighted with the strength in the U.S. economy, delighted and surprised with the strength in the U.S. economy that I've seen. In many markets, new home building remains strong and resale prices for housing surprisingly strong, despite the fact that the interest rate paid on the most popular mortgage product, the 30-year fixed, has doubled within 3 years. 2, employment for people who are employable, that is to say, for people who have skills that the market demands, remains very strong. While I'm cautious about the impact of higher cost of capital in the longer term, I'm delighted that we've survived as well as we have, as long as we have, given the precipitous rise in interest rates that we've seen.
Well, I think what you mentioned with real estate, I think the Fed has kind of created a distortion also, and then the policies towards building a new home, getting the permits and approval for these things. So you have a situation now where interest rates were so low in the 30-year mortgage for so many years that it was prudent for a lot of people to lock in a 30-year mortgage at a low rate. And honestly, it doesn't make any financial sense for a lot of people right now to sell their home when they have that mortgage locked in at cheap and home prices aren't crashing. It doesn't make any sense to sell their home and go and try to buy another home at a high mortgage.
I think what you say is true. And despite that, new home sales are fairly strong. I'm not sure what that says, other than the fact that workers who actually can add value in this economy can still make enough money to buy a home in many markets. It's notable, too, that in some of the markets that I would have expected to be particularly strong, coastal California as an example, irrespective of the very high prices relative to the mean income levels. I guess it's the difference between the median and the mean that makes a difference. Employees, for example, in the tech economy, are still enjoying enough personal income that they're able to keep housing prices in some markets like Silicon Valley, at least new home construction, fairly buoyant.
Yeah, I think that's a good point. So if people are affluent and they don't need a mortgage, or they only need a mortgage, say on 30% or 50% of the value of the home, it's not going to hurt them as much as someone that's only going to put down a 20% down payment and then they need a 7 or 8% per year mortgage on that for over a 30-year, because then they're paying I think the numbers are over $500,000 in additional interest payments just on a mortgage over a 30-year mortgage.
I think that's accurate.
The other part of this is, I think the home builders, I heard Ivy Zellman talk about this on a Blockworks macro interview, and she's considered one of the top real estate experts out there. She was warning about the 2008 housing crisis a couple years in advance. She said the home builders are actually subsidizing. So the home builders are actually subsidizing a lot of these new home builds to get off their books. They're subsidizing by over 100 basis points. I think she said 200 or 300 basis points in some cases. So they're sacrificing a lot of their profit margins to sell those new homes.
I can't comment on that. I don't have the experience in real estate to go that deeply into it. I just look at new housing starts and housing transaction volumes relative to what I would have expected with a doubling in the cost of capital, and I'm impressed by the strength and resilience in the U.S. market. I will note, Jason, that in the first part of the decade of the 70s, admittedly going back very, 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 very far, the economy was reasonably resilient for 2 or 3 years to higher interest rates, perhaps as a consequence of behaviors learned in the 1960s. And it wasn't really until 1974 that the pain was felt across the economy. That pain caused the Fed then to pivot in late 1975 after having raised interest rates a bit. So it is possible that what we have seen in the economy isn't going to last, that there's going to be a lag around the higher cost of capital. But again, I'm a credit analyst. I'm no economist.
Yeah, I would agree with the lag effects. I think eventually the consumer with around $6,000 average credit card debt at over 20% interest rates, we're starting to see a spike, Rick, in the last couple of months for people who locked in those low mortgage at home equity loans. So yeah, I think we're going to see lag effects. I don't know the timing on this, but I would expect it's going to start to hurt the consumer discretionary companies first, and some of the regional banks who have a lot of exposure to all this stuff with credit card debt and auto loans, small business loans, commercial real estate loans. But it looks like residential real estate, compared to a lot of the other stuff I just talked about, it looks like residential real estate compared to a lot of the other stuff I just talked about looks relatively safer.
I don't want to comment on all those sectors because I'm not familiar with all those sectors. I'm very familiar with banking. And I will tell you with regards to banking that the biggest risk still for them is borrowing short at variable rates and lending long at fixed rates. That brought down the U.S. savings and loan business. It brought down First Republic Bank. It brought down Silicon Valley Bank, and banks are still doing it. The Fed, in this circumstance, frankly, allows the banks to perpetrate fraud legally by discriminating on their balance sheets assets held for sale and assets held to maturity, which is to say a bank that has a 10-year asset on their balance sheet where the market value of that asset is substantially less than the purchase price. If the bank puts it in the category called held to maturity, they don't have to market. They don't have to take a hit against capital. If you look at the banks in terms of repricing their assets on a mark-to-market basis, even Bank of America is insolvent. They don't appear insolvent. And if the Fed can float them, they won't be insolvent. But the truth is, if you mark to market Bank of America's long-term assets in the face of higher interest rates, which means a lower capitalized value of distributions, the Bank of America assets to liability is insolvent today. And that's true for many community banks around the country.
Well, didn't Bank of America just write down about over $100 billion worth of bonds in the last 4 to 6 weeks, right?
I'm not familiar with that. I'm just familiar with the very published results from a lot of banks about the mark-to-market losses in their portfolio.
Oh, I think they were actually the only big bank that actually was honest and took a charge and wrote down some of their losses on their older U.S. Treasuries and other bonds. And the market just kind of basically shrugged it off. The market said, "Oh, they're a too big to fail bank. They're considered a GSIB or whatever the official government classification is. We just call them too big to fail banks, one of the 5 or 6 ones here in the U.S." And the market just shrugged it off.
I think you're probably right in terms of the market's reaction. It's interesting that people continue to transfer deposits to the very large banks at little or no interest rate because they think the money is safe. The fact that you are depositing money and losing 450 or 500 basis points a year in interest payments means that pro forma of your own volition, your deposit isn't safe. You're in a guaranteed loss position. But often investors and savers and speculators, and particularly voters, are irrational.
Yeah, I would agree with that. I think a lot of people are chasing yield. They're going into the short-term U.S. Treasuries right now. They're going into money market funds. But this seems to be hurting the regional banks the most, Rick, because during 2020, 2021, they had super cheap cost of capital. They had all this depositor funds from stimmy checks and small business loans and all these things coming in. And so they were giving out loans. They were buying U.S. Treasury bonds or buying mortgage-backed securities, a lot of different assets. And now it looks like the regional banks have a lot of problems with their loan books and with older bonds.
I think a lot of incumbent banks have problems with their loan books. What is particularly damaging to the regional banks in terms of their deposit base is not disintermediation to treasuries, but rather disintermediation to no interest products offered up by the financial supermarkets, which is a different way of saying stupidity among American savers.
So you don't think then that commercial real estate, that the regional banks have what some of them have 50% or more of their loan books to commercial real estate and small business loans. You don't think that that particularly is going to take out the regional banks if things get bad in the next couple of years?
I don't think it's a problem that segregates them from the money center banks. I don't think that and I think it depends on the regional bank that you're talking about. And I guess most of this discussion involves the nature and the names of the regional banks that you're talking about. A regional bank is an example like Farmers and Merchants Bank of Long Beach, where 20% of total assets is represented by equity, where loan loss reserves on a continuing basis are 5 or 6 times loan loss experience, which is to say a sanity-based bank is not a bank that is going to experience difficulties in any degree from the misbehavior that you're talking about. If you talk too about the impact of SBA, small business, or commercial real estate mortgages, while I agree it's a serious problem for the small banks, that is to say the regional banks, it's a big problem for the big banks too. The only thing that stands between the big banks and recognizing the problem is your suggestion, the government's suggestion, that they are in fact too big to fail. I think that depositors, investors, and borrowers who segregate on a rational basis between banks, not merely the cost of funds, but rather the stability of the institution, will do better over the next 10 years than those who don't.
Yeah, look what happened with First Republic, how JP Morgan basically got all the good assets from First Republic, all the good stuff, all the good employees, all the good assets, and all the toxic liability garbage stuff the FDIC and the taxpayers got stuck with.
Of course. Privatize the profit, socialize the loss. It's the American way. That's what you vote for.
Well, the big banks get that stuff. The regional banks, I think Janet Yellen hinted at this. I mean, normally she doesn't tell the truth or she's wrong all the time, given her track record. But she actually hinted, I think, in February or March that there was going to be a lot more bank mergers.
I hope there will be a lot more bank mergers. There's a lot of banks of all sizes that don't deserve to exist. Listen, Jason, we went through 40 years of the most benign economic climate, really, in history. And our activities, I think, were governed by the fact that we, in the period 1982 to 2022, lived in the most riskless period in human history. The consequence of that is that people who deposit money don't take the time to look at the statement of financial condition of a bank. They don't look at equity as a percentage of total assets. They don't look at the composition of the loan book. They don't look at the liquidity of the bank relative to now deposits. What people have been trained to do, I think, is to trust that everything is going to be okay, that the regulators are going to look after them, and that's a recipe for disaster.
Well, during that time period, you also had a bond bull market, and in general, after Paul Volcker, interest rates, except for a few rate hiking cycles that were relatively short, you had interest rates in general trend over 40 years falling.
Absolutely correct. You had U.S. dollar hegemony, which meant that for American savers, you were able to export your fiscal problems, and you had, as you say, both more than ample liquidity, and as a consequence of that, declining interest rates. I suspect that all of that, at least for 10 years, is over.
So I want to transition to cost of capital for miners and oil and natural gas producers in this type of environment. I know you financed a lot of natural resource companies over the years, and we've talked in prior discussions about how cost of capital for a lot of these mining companies, juniors and producing miners, even if they only have a couple mines, is high in a low interest rate environment. What is our cost of capital in this type of environment?
I think you have to segregate in that question. For 80% of the junior miners, their cost of capital is sub-zero. If you define cost of capital as the premium that you extract from the market over net present value, most junior companies in the mining business have no net present value, which means if they're able to raise money at any price, that their cost of capital is sub-zero. The problem becomes the best of the companies that do deserve a place on earth, the companies that are arguably selling at discounts to net asset value and then must raise money. And for those companies, the cost of capital is extraordinary. This is a market unlike most markets I've ever seen, in that you are taking down the good, the bad with the ugly. I will say that high quality juniors are able to get financed, and they are able to get financed on at least fairly reasonable terms. I note that the last 6 private placements that I personally have participated in have been oversubscribed. And although I'm a fairly prominent investor, and I am alleged to be of use on a shareholder roster, I have been cut back on my allocations in the last 6 private placements that I've attempted to participate in. Now, certainly with the larger miners, and in particular with the major integrated oil and gas companies, those companies are experiencing a cost of capital that is irrational relative to their prospects in the world over the next 10 years. From an investor's point of view, of course, that's a wonderful thing. As a check writer, I want the cost of capital to be high. If I'm lending money to an oil company, I want that oil company to have to pay me a little too much. If I'm providing equity to a company, I want them to have to issue that equity to me at a discount to what I think the other equity holders, the other equity is worth. So as a check writer, as an investor, I appreciate a circumstance where there's a high cost of capital. As a trader or as a company manager, of course, that high cost of capital and the resultant lack of liquidity is a cost to me.
So for oil and natural gas producers, what ExxonMobil and Chevron, they have free cash flow and low cost. So they have probably cheaper cost of capital and they have free cash flow. So they don't have to go to the market and pay a high cost of capital right now. But we're seeing for some of these shale drillers that have producing wells, I mean, they're selling their assets now out to the larger companies that are publicly traded, the private shale drillers now, because the cost of capital is too high with the debt to go and borrow capital. Or if you're an investor, I mean, someone like you, Rick, and you're looking, you can earn U.S. Treasuries or money markets at quote unquote risk-free 5% or more. Why do you want to go and invest in a private oil and natural gas driller drilling shale wells that have rapid depletion?
Well, Jason, precisely the reason why in retirement I've helped start Battle Bank. The idea that I can become a senior secured lender in the oil and gas business, the business that I grew up in, and I can compete with the large money setter banks because the money setter banks are drawing their money away from the oil industry as a consequence of politics, is my fondest possible dream. The idea that I can once again myself participate in the senior secured revolving credit facility for high quality but small companies is extraordinarily attractive to me. That's one of the main reasons why at age 70, I'm starting a new bank. I can't imagine a better opportunity for me than this.
Yeah, a lot of the banks, because for our listeners out there who are not aware, because of ESG policies, a lot of these pension funds, institutional investors, and banks, also large corporations, they're just steering away from investing in normal energy companies. So oil, natural gas, coal. There are some LNG projects, but I mean, given the interest rates, it's going to be difficult.
And for somebody like me, that's a wonderful circumstance.
So for miners, for cost of capital, if a company's if they're, let's say a junior and they have a good mine, let's say they're Osisko Mining in Quebec and they have the Windfall project, which is a really high grade project, are they going to still be able to get the financing to build a mine on their own, even though gold and silver prices are high, or interest rates going to make that prohibitive?
No, actually, there's an abundance of capital now for non-investment grade single mine companies. That's a business that I've been involved in for 20 or 25 years. Going back 20 years ago, there was basically me and Ned Goodman in the business. There is probably now $15 billion in revolving capital available. The industry doesn't like the price they have to pay for the capital. When I was in the business 15 years ago and 20 years ago, when the prevailing interest rate was at or a little higher than it was today, the total cost of funds, not the headline cost, but the total cost of funds around limited recourse project finance was about 15% per annum. Interestingly, today, that number got as low as 12%. That number's back up around 15%, which is to say that the interest charge payable to a company that can't borrow on balance sheet because they have no credit, where they have to borrow on a limited recourse basis, construction finance, the cost of capital is unchanged, despite the fact that the overall interest rate in the economy is lower. That isn't to say that companies are happy about a 15% cost of capital, but that's what the market dictates. The market is, in fact, oversupplied with capital for companies like Osisko Mining.
That's interesting because didn't they have to get a partner? They had to get Goldfields because Goldfields did a pivot after they dropped out of the Yamana gold bidding.
What you will see happening is that increasingly, companies that can borrow on balance sheet or at least on a limited recourse basis are partnering with companies that are sole risk companies because they can lower the acquisition cost by as much as 400 basis points by borrowing the balance sheet of the investment grade issuer.
Do you think then with interest rates at these levels that those companies are going to have to sell more gold or silver byproduct streams?
I think that the premium that the market pays for royalty and streams means that companies can lower their cost of capital by taking on a stream with an implied valuation of 7% cost of capital relative to a construction facility with an implied cost of capital of 15%. If the companies are telling you the truth, and I think they believe that they are telling you the truth, when a mining company tells you that they're selling for half what's they're worth, that means the most expensive form of financing, of course, is equity. Now, many companies say they're undervalued. What they mean is that they're selling for a lower price than they would have sold for 4 or 5 years ago. That's not the same as saying that they're genuinely undervalued. But for those companies who are genuinely undervalued, it turns out that equity is an extremely expensive form of capital. Market, go ahead.
I actually want to ask you a case study about this since you're talking about this is Equinox Gold, since they're trying to, we know how difficult it is in almost any environment to bring a large new gold mine online, but Equinox tried to bring it on during the pandemic with their Greenstone mine in Canada. The project economics looks good, but over the last, 2.5 years, the share price for Equinox Gold is down, over 70%. Now, if the mine comes back online, though, at the project economics, the company and the stock would turn around fairly quickly, though, right?
I'm making a bet that that's precisely what happens. I think that the Equinox share price has been depressed because the market looked at capital cost blowouts across the Abitibi in Ontario and Quebec. They looked at things like Cote Lake. And the market bet that because of the problems that other people had building mines in northern Canada, that Equinox wouldn't be able to do the same thing. I'm informed by the company and by my very good friend Ross Beatty, the founder of the company, that in fact that mine is on time, on budget. If, as you suggest, that mine is completed to nameplate capacity in 2023, and we get some sense of operating performance in the first quarter of 2024, if that mine is completed on time, on budget, and obtains nameplate capacity, I think you'll see a substantial re-rate of that stock. Remember, I began the sentence with if.
Yeah, that's the question about bringing a new mine online. So like the average listener out there, the retail investor, they're just looking at the share price. They're not understanding how difficult it is. And it's not a tiny little gold mine. I mean, this is 450,000 ounces a year of production. This is a large scale gold mine. I think there's a 14-year initial reserve life, but most of the property hasn't been drilled. And the cost, you said nameplate cost. I mean, the cost, if they hit the cost number, Rick, it's going to be under $900 an ounce. It's going to be an impressive mine, especially if they can extend the mine reserve life past 14 years.
That's correct. Remembering, people who are listening, all this bullish stuff we said was predicated on if. I am betting, personally, that if will occur. I have known the people behind Equinox, including the founder, Ross Beatty, for a very long time. In the case of Ross Beatty, 4 decades. And I have watched him and his team, primarily at Pan American, build a lot of mines. And I believe that they will be able to repeat their success here in Ontario, in pardon me, in Ontario. And the published material from the company suggests that they are on time, on budget, that they're, in fact, 85% functionally complete with the mine. We'll see.
Yeah, this is for listeners out there. This is the problem with holding shares while a medium-sized company or a small company is building a sizable mine like this. So there's a delay, or cost of capital is very high in a higher interest rate environment, and then all of a sudden the share price starts going down because Equinox has had to, I think, do additional financings over the last 2 years. Not recently, but I think there was one 18 months ago, something like that. And so like the share price is down, but it could turn around quickly if the mine comes online, like Rick says. Then they have all that cash flow and free cash flow, and they pay off their debt very quickly, and the balance sheet's fixed.
In truth, if they complete the mine on time, on budget, nameplate capacity, and the stock doesn't go up, the company will be taken over. What happens in a market like this is that people that have low cost of capital take over people that have high cost of capital. That's the way it works.
Oh yeah, that mine would look very attractive to a larger, medium-sized gold producer if it hits anywhere close to the production costs and the reserve life.
Correct.
So, building other new mines, do you think there's a lot of other good mines out there, similar to Windfall in Quebec or Greenstone for Equinox Gold, or you think that those are two of the cream of the crop?
I do. You need to look beyond Canada. Certainly Bellevue in Australia, absolute first-class mine. There are several around the globe that look to me to be very promising. And if you look at advanced exploration, particularly outside gold, Australian names like Meteoric and Sovereign come to mind. Deposits that, as a consequence of the malaise in natural resources, aren't attracting investors' attention, but deposits that, at least at present, look to be potentially absolutely tier one deposits, $10 billion or more in situ recoverable reserves and resources, best cost quartile worldwide, best return on capital deployed worldwide. I'm seeing a reasonable amount of opportunity in the market these days, and I'm seeing it at prices that, while they may not be knocked down cheap like they were in 1990, are certainly attractive given the outlook I have for commodities pricing in the next decade. I guess one of the differences, Jason, is ironically at age 70, I've become quite patient. I've learned in 50 years of investing in natural resources that where I make real money, that requires compounding, and compounding requires 5 or 6 years. Many of the people who don't want to compete with me in high quality juniors seem to have trauma holding stock over a long weekend. They have a 3-month expectation period, or a 6-month expectation period, or a 12-month expectation period. I have a 5-year expectation period.
So speaking of 5 years, there's a lot of negative sentiment for a royalty and streaming company, a mid-tier one like Sandstorm Gold. Do you like the acquisitions they've made in the last couple of years to kind of diversify away from just adding the growth of Hot Mod? It seems like they've added a lot of growth in Canada, the US, Chile, South Africa. Oyo Tolgoi, just the counterparty now is much stronger. Rio Tinto owns most of the mine now. So Turquoise Hill which had balance sheet problems and couldn't handle the funding. It seems like a lot of things are changing for Sandstorm Gold over the next couple of years.
I think the biggest thing that changes for Sandstorm over the next couple of years actually is Turkey. The cash that should come in from Hod Maden, I think, will make a difference. I think that the share price malaise that you're seeing in Sandstorm is a consequence of the fact that they were very aggressive purchasers of stock, and then they did an equity financing at a price that was substantially lower than the cost of the shares that they had repurchased. That was a fairly ugly gaffe, and I think that that shook people's confidence in the investment and capital deployment acumen of management team. And I think what real investors are going to look for now in Sandstorm is the way that they reinvest the money that they get from Turkey, the recycle ratio, how many units of production, how much net present value they can acquire for the capital that they spend in acquiring those assets.
Oh, a lot of people, including institutional investors and retail, actually said that they were worried that a lot of the future growth was solely focused on Turkey. And then there were all the delays for Hadman in Turkey. So the project itself is actually good, but like the project timeline has, I think that the pandemic delayed it like an extra 3 or 4 years.
Yeah, but the net present value of the company in terms of disposable cash flows, I mean, the industry was right. It was Turkey, 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 and Turkey.
Well, I was the deals that they've done though by buying Nomad, which I think was one of the cheaper, smaller royalty companies because a lot of their future growth was not priced in, and then adding the base core deal. There's a lot of diversification. A lot of the assets are under construction now, and I don't think like the Greenstone Gold Stream and a lot of the other stuff is priced into the Sandstorm Gold stock yet. All those additional cash flows that are under construction and coming online.
I would argue that you're likely right there, but I don't think that's the reason for the malaise in the stock. I think the reason for the malaise in the stock was partly the delays around Hadmaden, but in particular the miscalculation by Sandstorm of how much money they would need, how much they could spend in buybacks, and then replacing replacing the equity that they bought back at a lower price than they had bought back that equity for. That was a rather large strategic blunder that the market's punishing them for, rightly.
Well, they didn't see that interest rates were going to rise at this rapid pace. They got caught off guard because remember, they did the deal for Nomad and the other deal. They did all those deals right before the Fed started raising interest rates. They started adding all that debt to their balance sheet. So,
yeah, understood. As opposed to using equity that they had spent to buy back stock at a higher price than they issued it.
yeah, I think a couple years from now, I think people will not care as much if the company's a larger, more diversified with the cash flows. But yeah, in the short term, yeah, I agree with you. Also,
Well,
there was a lot
particularly if they're enjoying $100 million a year in free cash flow from Hadmaden. I think what the market is going to look at is their ability to deploy that money. I agree with you, by the way, on the Nomad acquisition. I just disagree as to the reason for the malaise in the share price.
I also want to ask you about EMX. So that's a smaller royalty company, and they seem to be trading at a discount because they've had some of their royalty checks not payable. So do you think that's one of the cheaper royalty companies?
I'm not sure that EMX is cheap on a royalty basis. I think it's cheap in that they generate a lot of royalties with their own prospect generation business. Most of the competitors that they have in the royalty business have to go out and buy aftermarket royalties, very much like Sandstorm did. EMX has created something like 100 royalties from their own exploration business. And EMX thus far has not yet enjoyed a major exploration success. But 20 years of funding exploration with other people's money is the single most efficient way to generate a large exploration success, and hence a royalty on a large exploration success. I would note too that EMX is particularly competent in terms of geology, so their ability to analyze royalties, either producing or non-producing, from a technical point of view, is better than at other companies of similar size. The fact that very recently EMX inked a joint venture on royalty generation with Franco-Nevada, the industry leader in royalties, tells you something about the way that the industry itself views the intellectual capital at EMX.
Or Franco also did a private placement, I think, of 10 million 12 or so months ago, but maybe Franco thinks the stock is cheap and they're going to eventually take the company over and put the geologists in-house.
I think for Franco, it's very much a library card. I think that they would like to do more by way of joint venture with EMX. I think they also think that perhaps at some point in time in the future, Dave Cole wants to hang up his spurs, and I think they'd like to have an inside track on buying it. Understand that there are other mining companies like SSR, which are also fairly decent size EMX shareholders. So it'll be a fair fight if somebody goes to take them over.
Are you surprised that Franco hasn't been more aggressive compared to some of the other royalty and streaming companies? I mean, the mid-tier ones have been very aggressive trying to merge and scale up and have more diversification. Are you surprised that Franco hasn't been more aggressive in this environment?
There haven't been very many top-tier royalties and streams available. Many people in the industry know that there are some very, very large potential transactions out there, particularly in the streaming side. And I think that both Wheaton and Franco-Nevada are keeping their powder dry for very large transactions on multi-decade mines. I'm not talking about 2 or 3 million ounce deposits. There are very large potential capital transactions out there, probably 5 or 6 of them, that could deploy billions of dollars at reasonably attractive rates of return for very long periods of time. And I think both Franco and Wheaton look at the possibility of deploying capital in that fashion and see it as being more transformational, but also, frankly, more economic than coming down into a space where there are 20 or 30 people competing for a $30 million royalty or a $50 million stream or something like that. I think both Franco and Wheaton are saving themselves for the $1 billion plus transactions, which, by the way, I believe will take place in the next 2 or 3 years.
So I think you're referring to a copper mine, a giant copper mine or base metal mine that has a gold or silver byproduct then, because there's a lack of copper supply long term if there's going to be with ESG and electric vehicles and upgrades of people's infrastructure and electrical grids?
Certainly every mine transaction that I'm thinking about has a copper component to it.
I want to ask you about costs for the gold miners. So we've had the Q2 earnings come out in the last month or so for a lot of these gold miners. Some of the gold miners, the all-in sustaining costs, they're looking around $1,500 an ounce, or some of them even over $1,500 an ounce now. When you compare the costs, though, to how low the costs were in early 2020 and 2021, when energy prices were lower and capital costs were lower, some of the miners were producing at around $1,000 an ounce, and here we are 2.5 years later, around $1,500 an ounce. Are you surprised that costs have increased this much in under 3 years?
I'm not. So much of the cost component of big mines is energy that an increase in energy prices makes absolute sense. But there's been cost creep other places too. In particular, skilled labor has gone up a lot with inflation. But in addition to that, steel has gone up. And what we don't talk about too much is that social rents, which is to say taxation, government royalties, the cost of regulation, cost creep from the center, which is to say cost creep from the state, has been more extraordinary in more cases than energy cost increases. The other thing, Jason, that the industry ought to come clean with is the extent to which in 2018, 2019, 2020, the mined grades in many of these deposits exceeded the median reserve grade, which is a fancy way of saying that they were high grading. The mine was generating more cash than it would otherwise have generated, applied ratably over the life of mine. And this caused them, in some cases, to understate the costs that they were enjoying in 2019, 2020. So both things are true.
So if there was high grading over a long period of time during the bear market in gold and silver, what's going to happen going forward to some of these mines that were brought online the last 5, 7, 10 years then?
Investors need to pay real attention to the financial statements. They need to pay attention to what the remaining mine grades are over the mine life. In other words, people need to do some work, which people are loath to do. There are certain companies for whom I think that will be an issue. I think that their costs will be higher in the future because their average grade will be lower, and also because their costs in the past were artificially low. And I think that's something that investors in the sector need to look to.
Is that what happened with Pan American Silver over the last 12, 18 months? Because all of a sudden their gold mines, their copper and gold mines, and some of the silver mines in Mexico, especially the gold mines, the cost just exploded much higher.
The two problems that Pan American had, I would argue, by the way, they're friends of mine, so this isn't a criticism per se, but I think that they scrimped on sustaining capital investments, both in Mexico and California. I don't think that they high graded. But I also don't think that they maintain sustaining capital investments to the extent that they should have. And I think particularly at Mesquite in California, the stripping schedule should have been accelerated. I think they agree with that now, and it wasn't. In Mexico, one of the things that happens is that there have been periodic labor problems in Mexico. And I think perhaps Pan American was sending a message to people that the employment that they had intended to enjoy as a consequence of sustaining capital investments wasn't going to occur until they had better fiscal stability. In other words, I think there was a political element to the underspending in Mexico.
Yeah, look at what happened with First Majestic Silver, how they've started investing outside of Mexico. Look at Penasquito with what's happened with Newmont Mining and the strikes there. Now, Pan American, I think they did long term. I think that was smart, buying the producing copper and silver mines from Yamana Gold, getting those assets there. But they had some debt on the balance sheet. They just sold some assets. So do you think then that that's going to fix their balance sheet problems and some of their operational problems, adding those other assets from Yamana Gold?
Their balance sheet problems are fixed. The $470 million copper disposition in Argentina effectively fixed the balance sheet. I think there's about $100 million spread between net cash on the balance sheet and net debt on the balance sheet. And both the legacy and the acquired assets from Yamana are cash flow positive. There is some deferred working capital expenditures that will need to be made on the Yamana asset. The problem with that acquisition, from my point of view, was that Pan American obviously believed that the near-term upside associated with the Yamana acquisition was worth the 100% dilution that it caused against the existing Pan American assets, and in particular to the non-producing Guatemalan and Argentine assets that had so much leverage to political change and to a higher silver price. What Pan American management was actually saying was that the Yamana assets were more attractive than the upside associated with the Pan American assets. I think the second problem with regards to the stock is that many of the Yamana holders held it in anticipation of a takeover. And when the takeover occurred, their money was made. They sold it. They weren't necessarily constituents of Pan American. They were rather in for an arbitrage trade. My suspicion is that when the rest of the asset dispositions take place in Pan American, there will be a lag because the acquired assets suffered, in my opinion, from a lack of sustaining capital investment under Yamana. But I think that the Pan American team is unusually adept when they put their minds to it, to adding capital to capital-starved deposits and turning them around. And I think this has a happy ending. I think, too, that the impasse that they've suffered in Guatemala with regards to restarting that massive silver mine are much closer to being over than many people recognize. I think that they will get the go-ahead from local and federal constituencies in Guatemala as early as calendar year 2023. And they'll be able to do a hot restart. Remember that there's almost 500 million high-grade ounces of silver in that deposit, which currently doesn't report to the Pan American account.
So do those types of deals normally occur in mining where the mining company has a really good mining asset that's either been delayed or it was the project was temporarily brought offline, or there's been many years delay, and then all of a sudden management just kind of panics and decides that they have to go out and buy another asset, similar to what Pan American did, to get some cash flow diversification, and then the shares get diluted? That normally happens in mining more often than not in different cycles, doesn't it?
I think very often the institutional investors who have a quarterly perspective demand that sort of transaction. It might be that the Pan American management team believes that they are better long-term stewards of assets than the departing management team was. And I suspect that may be true. I was concerned as a Pan American shareholder that my interpretation of the upside in Pan American's undeveloped projects was higher than the management team's was. And as a consequence, that I suffered some fairly substantial dilution from them. And I think they will be successful if they're successful in financial engineering, which is to say, if they sell off the projects that they don't need, and if they lavish love, care, and attention as they've done in the past on the projects that they acquired, and particularly if the impasse in Guatemala gets resolved, never mind the impasse in Argentina, then Pan American, I think, has a very bright future.
I think their asset base is a lot better post Humana deal because I like Cerro Moro. I think it has a lot of exploration upside still. It has good cash flow. I think they're expanding the mill too. But for listeners out there who don't buy gold or silver mining shares, I mean, just when you think that the company could is disciplined and the assets, something could go wrong, and then all of a sudden there's share dilution to fix a problem or add a new asset with cash flow or fix the balance sheet.
True in all industries, sadly.
Well, isn't mining arguably the most difficult business, Rick, in your opinion?
No, I don't think so. I really don't. I think that many of the technology businesses are more difficult because the technology changes so fast. You can invest fairly heavily in a technology where you're the world leader, and in 18 months, some group of kids in Silicon Valley has invented a better way of doing something, and you're out of business. I think from an investor's standpoint, too, the business cycles in mining are more predictable and shorter than they are in technology. So I think you have to be a much smarter investor to be successful in technology than you do in mining.
You don't think that mining is more difficult because all the moving parts in a mine, so many things could go wrong, all the maintenance capex. I mean, the capital costs for mining are way higher than a lot of other businesses.
Mining is more capital intensive and it's more cyclical. It's also lower tech and more predictable. I would suggest that I've been served very well being an investor in mining, not because I haven't made mistakes. I've made some huge mistakes. But the truth is, in mining, if you buy a sector when it's out of favor, when the selling price of the commodity is less than the average cost of production, so that the price of the commodity has to rise in order for it to be useful to society, it actually becomes a fairly simple business. That doesn't mean that you don't get lots of things wrong around the edges, particularly if you speculate and take chances. But while mining is a hard business, all businesses are hard businesses, and mining is more understandable than many businesses. Imagine if you ran Foxconn. Imagine if your business was employing 250,000 people in China to make 800 gizmos for people like Apple Computer. Imagine that you have to constantly retool to keep up with advances in technology. Imagine that you're investing to keep up with these advances in technology and somebody invests something better but doesn't build it through you. I've been in business now. I guess I started my first business when I was 20. I'm 70, so I've been in business for 50 years. And sadly, Jason, I've never run into an easy business.
Yeah, I would say the royalty and streaming companies, when they get to scale, when they have some diversification and free cash flow, when you get to the medium size, it becomes a lot easier. But those businesses are rare because they have such high profit margins and free cash flow once they get to a certain scale. But most businesses aren't that. You can run many $billion of business with 20 or 30 people, but most businesses aren't like that.
I would completely agree with you there. A large royalty or streaming company, which is to say, frankly, a Franco or a Wheaton, to a lesser degree, a Triple Flag or an Osisko Royalty or a Royal Gold. Those businesses are uniquely good businesses. What they require is absolutely rigorous discipline. You can't overpay. You have to have lots of dry powder available in a down cycle, which means that all of your really good decisions take place in a 2-year period out of a 10-year cycle. For most of the time, you have to be willing to do something very difficult, which is nothing. Warren Buffett famously says that done right, investing is like a baseball game where there's no called strikes. If you miss an opportunity, it's all right because another opportunity is going to come along. So what you do is you wait at the plate with your bat, which is your money, and you wait till the pitcher gets tired and throws you a nice fat pitch, and then you swing at it. And that's what I think Franco and Wheaton are doing right now. There are people who want them to come down into the lower sector and compete or take over some of the royalty juniors whose asset mix, frankly, is less attractive than the asset mix at either Franco or Wheaton. What Wheaton, I think, and Franco are doing is holding prodigious amounts of capital and access to capital, and preparing to allocate wonderful free cash flow to a few very high-quality transformative transactions where nobody else can compete with them, which is exactly the right thing to do.
For our listeners who are not familiar, the royalty companies, the profit margins are way more robust, the free cash flow and profit margins throughout the entire cycle than a regular gold or silver miner. So for right now, whereas earlier we discussed that the gold miners, their costs are a lot higher than people expected, even with diesel prices low for the last 9 months because of higher labor costs, higher cost of capital, royalty taxes from governments, like Rick said. So the regular gold miners, their margins are being compressed. Some of them might only have $200 to $500 an ounce now margins of free cash flow, whereas the royalty companies, they have well over $1,000 an ounce profit margins. I think Sandstorm Gold has almost $1,700 an ounce profit margins, but the average for the industry is well over $1,000 an ounce profit margins for the royalty and streaming companies.
Correct.
So that affords them, they could just accumulate. They don't have to be, unless they have debt and they have to service the debt. If they have a fairly clean balance sheet, they could just accumulate that free cash, and either they can increase the dividend, they could do share buybacks, or they just accumulate the cash and wait for the next deal.
Absolutely correct. For the royalty and streaming companies, their primary cost is tax.
Well, shareholders want capital allocated to those different things, either for growth or dividends or share buybacks, depending on the situation.
Correct.
So I want to transition now to uranium. So you talked about sectors out of favor. Do you think now that uranium, it looks like a lot of people, even environmentalists, even a lot of Democrats now, they're starting to, I think there was a documentary out from a Hollywood movie producer in the last 12 months. Do you think that the uranium bull market is going to start to separate from the rest of the crazy global macro conditions that we have?
I do. I think that the political and social winds are decidedly in uranium's favor. An example would be in Japan, where a poll 5 years ago had the Japanese public almost 70% opposed to the restart of the Japanese nuclear fleet. The most recent poll showed that 64% of the population were in favor of an immediate restart of the nuclear fleet. Another example would be that the co-founder of Greenpeace is very solidly in favor of uranium. Now, until very recently, that hadn't necessarily impacted market participation. I note as an example that the product that I think is the sort of vanguard of uranium investment products, the Sprott Physical Uranium Trust, was trading at a 14% discount to net asset value. The idea that a trust that held physical uranium, where physical uranium had to go up in price, was selling at a discount to NAV was, I think, very silly. And it was reflective of the fact that for most of this year, we were in a stealth bull market for uranium. The term market in uranium is currently the place where 75% or so of transactions are occurring. It used to be that 80% of transactions took place in the spot market. The term market is firmer than the spot market, and the spot market is up by 20-something% this year. That's something that investors haven't noticed, really, until 2.5 months ago.
So
I think that we're exiting the period of the stealth bull market in uranium, and we're coming into a de facto bull market in uranium.
So for the listeners who don't know what the spot market is versus the term market, is the term market where a utility company, say a nuclear power plant, goes in and tries to buy uranium supply, nuclear fuel rods, or process stuff on a long-term supply contract?
Correct. A 5 to 15 year basis where the contract is often indexed, but the terms of the contract, which is to say the price that's being paid, particularly in out years, is opaque. It's shielded from the market.
And there's been a lot of consolidation too. I think Cameco, what they bought, a parts company. I haven't checked how that acquisition is doing. I know we were speaking about in the last couple of interviews that on paper it looked pretty good. But in general, if the spot price is going to go up, I think Cameco and Kazatomprom are the best position for uranium producers right now because they're the two low-cost ones.
I think Cameco is. I have a larger position in Kazatomprom because I personally consider it to be a better company. But sentiment is definitely against Kazatomprom. Most people couldn't find Kazakhstan on a map or couldn't pronounce it. And they see the political reality of it being compressed between Russia and China and think that's too hard a place. As I say, I own more Kazatomprom than I do Cameco, but I think that the early stage market participant will be Cameco, not Kazatomprom.
Well, Kazatomprom is the low-cost producer, but then there's a geopolitical risk. Also, they're not listed on American exchange, right? So if you're an American, you either have to have like an interactive broker account to buy it on the London Stock Exchange, or you have to buy it over the counter.
I would urge any of your listeners who have trouble buying Kazatomprom to call my former employer, Sprott Global in Carlsbad, California. They will happily effect a transaction for you in London, Kazakhstan, or Hong Kong.
As we wrap up here, Rick, I want to ask you about the commodities super cycle. So it seems like the narrative now is that the commodities bull market is over, interest rates are high, we have deflation headed up. Do you think we're going to restart a commodities bull market super cycle in the next couple of years?
I think the thing that stands between us and a commodities super cycle is the specter of recession. I think that anybody who is numerate will understand that we have underinvested in productive capacity around a broad range of commodities for 30 years. And as population grows and as demographics improve, which is to say, as the poorest of the poor around the world have their material living standards increase, we are going to have spot shortages, perhaps systemic shortages of a broad range of natural resource commodities. That's a given. It's a fact. You can have declining supplies temporarily if you have declining demand as a consequence of recession, and the price doesn't go up. It doesn't change ultimately the shortage, but it makes the realization of price increases around the shortage delayed. I don't think that there's any doubt in anyone's mind that 5 or 6 years from now, we experience shortages, perhaps severe shortages, of things like copper, oil, gas, perhaps phosphate. I think that people are not investing in the thesis because I think, as an example, the inverted yield curve is suggesting to us rather strongly that we will experience some form of recession, which will, for the time being, delay a natural resource bull market.
Well, also, Rick, in the case of energy, the conventional forms of energy, so oil, natural gas, and coal, you have ESG policies, and a lot of institutional investors, pension funds, banks, they either can invest or won't finance these regular conventional energy projects, despite, and this was shocking, we had record oil demand globally in March and April of this year. And that's with China not coming back online. And it's just like you said earlier, there's a bunch of people that are moving into their version of the working class in the emerging markets. And instead of buying like an SUV here in the United States, they're buying their first motorcycle or their first scooter, and they're consuming diesel and they're consuming gasoline.
The irrational response of the big investors absolutely delights a little investor like me. As you point out, despite the fact that the big thinkers in the world, that noted energy physicist Greta Thunberg, other wonderful commentators like Justin Trudeau or Biden, despite their suggestion that the oil industry is going to be over in 2030, peak oil demand probably occurs in 2065 and then trails off from there over about 40 years. What that means is that I have 25 years of increasing oil demand to set my net present value calculations against. Here's an interesting statistic, Jason, for people who believe that alternative energies will fill the void. Humankind has now invested almost $5 trillion in alternative energies, and they have reduced the market share of fossil fuels from 82% to 81%. That tells you, I think, all you need to know about the energy future of humankind, not merely for my lifetime, but for most of yours.
Also, Rick, as soon as the subsidies and unbid government contracts for wind, solar, a lot of these biofuel companies go away, the company within a couple of years goes bankrupt.
Who knows whether the big thinkers will reduce the subsidies? I'm not smart enough to outguess Washington or Ottawa.
Well, the DC insiders, Rick, are smart enough to know when they're reducing the subsidies because the shares already went out and the DC insiders already cashed out for millions of dollars in profits. I think the Secretary of Energy already did that for a cool extra 1.6 million in like 2 or 3 years.
I hope the voters notice.
I don't think they care. They're still voting for the two-party system, though, or the uniparty system. There's not, I mean, on energy policy, it's a little different, but each political party has like their pet projects for energy spending. I would love, I know you're a uranium and nuclear power bull too. I would love for both parties to just say we need to have constant policy here on building new nuclear power plants and investing in next generation nuclear power, but both parties don't seem on board yet. Maybe that will change soon, though.
I sort of think that's like hoping for the tooth fairy. It was a good thing when you were a kid.
Well, same thing with the two-party system and fiat currencies and government to do the right thing at this point.
Correct.
Well, Rick, I really enjoyed our discussion today. Could you tell my listeners more about Battle Bank and some of the other projects you're working on?
Yeah, two things I'd like to talk about. If your listeners enjoyed my perspective on natural resources and they want to personalize it, all they have to do is go to my website, ruleinvestmentmedia.com. List your natural resource stocks. Please no tech stocks. Please no pot stocks. Please no crypto. I will personally rate those stocks. No cost, no obligation. I'll rank them 1 to 10, 1 being best, 10 being worst. As you have alluded to, Jason, I'm celebrating retirement by starting a new bank, a sanity-based bank, a bank that will pay high interest on all deposits, including checking deposits, a bank that will allow you to save in a money market account or a CD in 20 different currencies, not just the US dollar, a bank that will lend you money against your precious metals holdings held in segregated storage, and a bank, too, that will allow you to open up a checkbook IRA so that your IRA can own an LLC, and that LLC can own a sole prop business, a single family rental home, a duplex, a fourplex. We believe your IRA is just that, your IRA. If you believe that your money is your money, or if you're unhappy with your current bank, check out battlebank.com or at the Rule Investment Media website. In the rankings database, under questions and comments, simply write bank, and I'll send you more information on Battle Bank.
Are people going to be able to buy physical gold and silver at Battle Bank and do type kind of bullion banking from you guys too, similar to Gold Money?
They will absolutely be able to buy gold and silver through Battle Bank, but there's no requirement to access Battle Bank service that bullion purchase needs to take place through us. It can take place through Sprott Money. It can take place through Kitco. It can take place through Miles Franklin or AppMex or any of the great dealers that are out there. In terms of gold banking, which is to say taking people's physical precious metals in an aggregated account and lending that precious metal out, that's something that we haven't thought about doing right now. Very often, if you're involved in so-called bullion banking, what you are doing is lending your bullion to the bullion banker who relends it, which means it's no longer your bullion. You are becoming the unsecured creditor of your bank. So if you are participating in bullion banking, you need to understand very well the balance sheet, the income statement, and the lending policies of your bullion banker. We are looking at bullion banking, but thus far, our bullion offerings are going to be limited to buying and selling and storing bullion for our customers, or lending against physical bullion held in segregated accounts, irrespective as to who the broker was.
Oh, that's a modern day fractional bullion banking. I don't like that stuff with the aggregated accounts. I mean, I'm talking old school bullion banking where people have, segregated accounts. And I would kind of like a more digital version of where you have a certificate, where the paper money was just a receipt and there was no fractional reserve or anything like that. It was just a certificate for gold or silver. But now you can do a digital version on your phone. No one has done that yet, but it's a good idea, probably.
I think what you will see is the basis for a gold coin come out fairly soon, sponsored by, among others, the World Gold Council. And that may ultimately allow the type of banking product that you refer to.
Yeah, I think the old school bullion banking there with the money as a receipt was good before the banks started getting greedy when doing the fractional reserve banking and started making the tickets for the gold and silver certificates with fractional reserve, the metal they didn't have.
Well, the customers are also greedy. The customers want to deposit gold and silver, and they want to get paid interest on it. And
Uh,
the expense for the institution of doing that in very small amounts, $100,000, $200,000, is too high. So the only way that the institution can pay people interest on their gold and silver is to aggregate that gold and silver and pay them interest out of a pool, which in effect suborns the individual interest in the gold and silver to the institution.
oh, that's interesting. Thanks for explaining that. So, do you have any conferences coming up, Rick?
I'll be speaking at the venerable New Orleans Investment Conference myself. That's the very beginning of November this year. In addition, Jason, as you know, Rule Investment Media sponsors virtual conferences on various subjects 4 times a year. The upcoming Rule Investment Media Investor Bootcamp, it's virtual, not physical. You have to attend on your computer, will be about royalty and streaming companies, something that there is very high interest on. Prior conferences in the boot camps included uranium, and silver and electric and battery metals. We're very much looking forward to our royalty and streaming boot camp.
I think the royalty and streaming model long term is a very good one, especially as there's an undersupply of copper. So I think these larger royalty and streaming companies and even the mid-tier ones, as they ingest these acquisitions that they made over the next couple of years, there's going to be a lot of opportunities for them to go out and buy gold or silver byproduct streams on future copper mines.
There's an argument to be made that almost any natural resource portfolio that an individual sets up could be well served limiting that whole portfolio to the royalty and streaming companies.
Well, that is my non-physical precious metal exposure for gold stocks. I don't own any gold or silver, actual gold or silver miners now. I only own the royalty and streaming companies now. I sleep much better at night just owning those shares.
It's a very good fact. In a raging bull market, you limit your upside, but you limit your upside by eliminating most of your downside, which is not a bad trade.
Well, Rick, I've survived less bear markets than you, but the bear market from 2011, 2012 to 2019 was brutal. And honestly, some of the mining shares were down so much and all the problems with some of them. I just feel a lot better owning a royalty and streaming company with diversified free cash flow and good profit margins in any type of bear market scenario.
Agreed.